This is an interview series called The Tradeoff, where we wrestle with important financial decisions inspired by the great Thomas Sowell's quote, "There are no solutions, there are only trade-offs." Today's topic is investing in line with personal values. This is commonly referred to ESG investing, which we'll get into. A common example is a concern for the environment and investing in such a way that one could help promote a better environment. That would be a common example. So we'll get into that today. ESG investing, as we call it, is becoming more accessible, but it's still not widely understood. To help us sort this out, we are joined by Grady Smith of Dimensional Fund Advisors. Grady, thanks for doing this today.
Absolutely. Nice to be here, Kevin. Thank you.
A little bit about Grady. He is a senior portfolio manager and vice president at Dimensional Fund Advisors. He has a general oversight responsibility for a broad array of global equity and fixed income strategies. His role also includes communicating about how Dimensional's portfolios are designed, implemented, operated, and the principles in academic research on which DFA, Dimensional Fund Advisors, is founded. Hence what we're doing here today. Grady is coming up on 20 years at Dimensional. Is that right?
That is right. In fact, next year will be 20 at the same time that the firm is 40 years old. So half the firm's lifetime.
I kind of feel like 2020 is worth 1.5 to 2 years of experience.
I would certainly agree with you.
Prior to that, Grady spent about 20 years doing management consulting, and he has a BA in economics from Stanford, an MBA from UCLA, and is a fellow CFA charter holder. Thanks again for being with us. I'll get into some questions, if you're okay with that.
Right, sure.
I think we really need to start off with just your best effort at sort of what is this concept of ESG investing, maybe a little bit of the history about it, just to give us a framework, because so many people are so new to this concept.
Yeah, and I guess I probably should start out with what the E and the S and the G even stand for, although I'm going to quickly expand on that because there's a lot of differences in how people view it in, kind of around the investment universe. So ESG is environmental, social, and governance. How we use it. Concept of environmental, social, and governance related. But there's a lot of different places where people will use different words to imply something similar in nature. Responsible investing, they'll use socially responsible investing, whatever it might be. So there's a lot of things out there. And one needs to be a little bit careful because they actually oftentimes don't really tell you much about what it is that they're actually doing or what they mean when they use those terms. So it is important to understand that there's not common language in many instances. Ultimately, the thing that they tend to share is this concept of expressing one's personal values as a part of their investment philosophy, right? And I think that over the years, you've seen a lot more of that as time has gone on. As an example, we've had many people that have had social related concerns that they express in their investment decision. That goes back for many, many years. It's becoming more prevalent, if anything, along with, as you pointed out, things like the environmental issues and climate change. So it has evolved through time, but it all comes down to that same thing. How do I express personal values into my investment philosophy?
I can imagine two ways, maybe there are more, of an investor approaching this style of investing. One might be purely from a values perspective, where that is the great priority, that somebody felt very strongly about carbon emissions, for example, and from strictly a values perspective wanted to not support a company that was emitting a great deal of carbon into the environment. That might be an angle. Another angle might be somebody holding the opinion that by investing in such a way might improve the return on investment, because perhaps companies that take an approach that is environmentally friendly stand to do better than others that don't take that approach. So those seem like two different ways of thinking about ESG investing. From the research you've done, does there seem to be a trade-off on the investment performance angle that's to some measurable degree for expressing these values?
Yeah, well, there's good news and bad news there, in the sense that it doesn't necessarily tell you anything about what you might expect in returns. I suppose some people would say that that might be bad news if it doesn't tell you anything about it, about what you can expect for the future. But it really ties as much to what's the investor's expectation. They want to express their values within a portfolio investment construct. In many instances, they may view it as, if I express these values, I should therefore get a better return in the marketplace. And others may view it and say, despite the idea that maybe perhaps I'll get a worse return in the marketplace, I'm willing to accept that in exchange for expressing my values. And so there's a lot of different people that may have different views of what the importance of that trade-off is. If we look at it from an academic standpoint, you look at kind of the data that looks into this, you'd say, well, if you stick with sound underlying investment principles, and that would include things like diversification and pursuing those things that we do understand about differences in expected returns across markets, that in fact, incorporating an environmental or social overlay into that process doesn't necessarily bring you added expected return. But it also doesn't mean you actually have to lose return in the process either. And in fact, you can have a diversified portfolio that's effective for long-term investment horizons that incorporates ESG characteristics. It's kind of like you can have your cake and eat it too. But don't expect more, but don't expect less either.
I've had people asking me this before, and I struggled to answer it in a coherent way, which is, let's take, for example, Exxon Mobil, or we could pick any energy company. If somebody had a preference for excluding carbon-related investments, and they were considering a diversified portfolio, which would include those companies versus not, I'm curious, how can somebody make sense of what is the financial impact or likely financial impact of sending another dollar of purchases of Exxon stock to the portfolio how does Exxon experience that additional investment? Does it help them in some measurable way that somebody can make sense of?
Well, probably at the individual level, probably not a lot. Remember, when you go to transact in the marketplace, you're generally transacting with another individual other than the company itself. And so it's a trade between parties that either hold or wish to hold the stock, or wish not to hold the stock. And so it probably in and of itself doesn't have a direct impact. But when you aggregate it over many, many, many people or society more broadly, there is a potential for an impact. And the impact is, if you see decreased demand for a particular security, over the long run, that might in fact imply that you'd see a lower price than you might have otherwise been able to receive if more people had wanted to hold the security. From the company's perspective, if they recognize that, and if they recognize that it's being driven by, as an example, an environmental concern, a climate change related concern, that type of thing, then potentially the company might be guided to say, well, we might be able to increase the value of our overall stock through different approaches to actually managing in a more effective fashion environmental risks, social related risks, how we manage those risks, et cetera. And so in aggregate, it probably can have an impact. It's hard to actually measure what that impact might be, but arguably it can have some influence.
So is it fair to think about it in terms of the individual transactional level, buying one additional share alone, likely not that meaningful, but in aggregate, if thousands of people are expressing this same view, there could be some received impact at the decision-making level of the company.
There could, and by the way, that also ties to something we didn't really talk a little bit about earlier, which is the governance side of the equation. We talked a little bit about environmental, and most of the time what environmental is leaning towards is climate change related issues. Although there are subcomponents of that people think about. And the social considerations tend to be focused on things like things like avoiding certain types of stocks, tobacco, alcohol, gambling, firearms, whatever it may be, right? Not wanting to be invested in some of those things for either religious or for secular reasons, either one. But the governance side of the house is something that's also very important. How do you, as an investor, or in an aggregated situation like an investment manager, how does an investment manager interact with portfolio companies in order to encourage them to use best practices around a number of things? How they manage risks, the qualifications of the board members that they have, the way that they address environmental and social risks that they may have. All of those things come under governance, and that applies to all securities, really. And so this type of a thought process where you are both interacting with companies, but also putting your money, so to speak, in those companies that are doing what you would hope that they would be doing in relation to environmental and social risks may have some help.
As it relates to managing a portfolio of companies that have or don't have these various characteristics in a collective, diversified way, does the investor end up with owning more of a company that expresses positive environmental, social, and governance characteristics? Is that a way of thinking about how that would work?
Yeah, how you decide to weight a portfolio in relation to whatever the concern is. If you think of it as a social concern for a moment, and then I'll talk about the environmental as well. If you think about it from a social concern, oftentimes the social related concerns, some of the ones I mentioned before, are simple yes/no decisions. It's zero weight or it's included. And it's just part of investor preferences in that way. Climate change and in that entire kind of category of environmental related issues is a little different. There's some nuance there. If you think about it, we're all across society embedded in an economy that actually we're all exposed to environmental related issues across everything we do, whether it's the technology that we use, healthcare, and biotech and manufacturing and all these various characteristics. And so we think of it as, can you measure in a meaningful way differences in companies in terms of their impact on climate change? And you can do that at the portfolio type of level, meaning you can say, well, in general, energy companies and utilities, they oftentimes have very significant impacts on greenhouse gas emissions, as an example. But every industry has differences amongst them, including energy and utilities, in terms of which ones are, in some sense, the better actors around that issue and which ones are somehow in worse shape in relation to their intensity of their carbon emissions or something like that. And so you can apply that same thinking within any of the sectors, and you would say, well, I'd like to underweight those securities that kind of score the worst on whatever issues you're attempting to pursue. And I'd like to increase the weight in exchange to those that are the better actors in that regard. And that in and of itself is a way to manage kind of your exposure to something like greenhouse gas emissions, is to emphasize those that have lower intensity emissions.
So the most common way investors measure performance is simply return on investment. I'm curious, is there a way to measure the impact as an ESG investor with the expression of these values, is there a way for the investor to receive feedback on maybe what type of impact they're making from a value standpoint?
Yeah. So from an impact perspective, how much you're impacting the, kind of the environment around you in a positive way. And I'll separate that from a moment from the personal impact it has in the fact that you personally are not owning as much of these things that are of concern to you and to the environment. Two somewhat different things. You can have a lot of evidence and transparency and understanding of how much impact you have on your own portfolio in terms of your exposure to these things. And that is in fact something that may help you in terms of your own sense of how, of tying your values to your investment philosophy. But teasing out how much impact it is having on the outside world in terms of the companies themselves is a bit harder. And the only reason it's a bit harder is right now, there are a lot of different approaches that entities are using out there to do the same thing. And it's hard to tease out which ones are having greater impact, lesser impact, et cetera. It's actually hard to figure that out. Now, at some point, I suspect people will figure that out. We'll have some better evidence as time goes on as to what the potential impact may have been, but it's not an easy thing to determine. But simultaneously, it's much easier to determine that you're expressing your own values in the process.
Right. Can you imagine a future in which a common investor can, much like you described, there's some yes, no characteristics, tobacco, yes or no. Can you imagine a situation in which an investor can simply choose from a menu of these ESG characteristics and decide, check the box or decide how much exposure they want to each of these characteristics? Is that likely to be a way to invest at some point in the future?
Well, it's not impossible. Actually, it's not impossible even now. It's hard to do efficiently in terms of the costs of implementation in when you have relatively small asset pools to do it with. So there's a trade-off there that's going on, as you going back to your trade-off comment at the beginning of this. But it is something that you could say, yeah, you can picture that might well occur. Where you can actually take advantage of these are the things that are important to me, and can we organize something that effectively meets those particular needs? So yeah, I don't think that's impossible to do. I think it's hard to do, and I think the trade-off is mostly about the cost because everybody has such different views of what may be important to them.
That makes sense. I'm curious about new emerging social topics that people are concerned about. The one that comes to mind is censorship on social media platforms is a big topic right now. And it's something that some people are very concerned about, I'm sure, and perhaps they would like that to be involved in their investment decision-making process. Just as an example, I don't have a lot of data to support that, but just as a for instance, what do you imagine the process is for considering inclusion of that type of a trend in terms of the social concerns of investors?
Yeah, you can think of it as, changing times, evolving times drive new concerns that sometimes are actually pretty difficult to address, in large part because as you pointed out, data. That the data doesn't exist to allow you necessarily an effective way of understanding the problem and mitigating it through an investment structure without giving up on other aspects that you find valuable in the investing process. And so from our standpoint, we, the academic community, and the investors themselves are all changing through time as to what is important, what data exists to understand it, how does the academic community address it in terms of what they find in research, et cetera, and then does it fit into the actual ability to invest? All of those things argue for a contemplated thought process as you move through time, that you don't necessarily chase after the current flavor of the day, whatever that flavor is. And that's not denigrating the importance of anything. It's saying that some things last a long time, some things are relatively short in nature, and some things evolve as to what they mean through time. And so from an investment standpoint, as a long-term investor, you got to think about it as evolving through time and, addressing it as it becomes more and more understood.
My last question for you is just to help us think about, as new investors are coming across this as a possible strategy. And let's say that their best alternative that they're most comfortable with is just a very diversified portfolio of, say, US stocks, incorporating the entire marketplace. And that is their most comfortable type of investment. They're considering ESG investing. What would you say to that person to help them with their expectations? Because it may feel a little bit scary to move away from that. How should this in some way impact their expectations as an investor, whether it's in terms of volatility or an experience that may deviate from what they would otherwise choose?
Yeah, well, a couple of things. At least in the sense of how we think about portfolios, we seek diversification in portfolios just as a broad underpinning of everything that we think is important about kind of a long-term investing horizon. And so we do seek a broadly diversified portfolio. When you begin to take into account environmental or social types of issues as part of the construct, the more you push, the less diversified you become, right? But you can actually push fairly substantially in ways that are meaningful, that continue to end up with a very broadly diversified portfolio. So an example might be, instead of 2,500 securities, if you didn't put on a screen of some type around those issues, you might have 2,000 securities. Expected volatility doesn't change a lot in regard to those types of things. You still are owning a diversified portfolio. If the diversified portfolio is constructed properly so that it does have a recognition of kind of what the long-term drivers of returns are in the marketplace, then two portfolios that are comparable in nature, one with screens and one without screens, should in fact produce, on expectation, a very similar return over long periods of time. And so this goes back to one of the earlier questions where we talk about, can you expect more? Maybe, but the evidence doesn't suggest that. But do you have to accept less? No, you don't. And you can do that in a diversified way.
Grady, this is an important topic. It'll become increasingly important, I think. Thank you for the education today and helping us think more deeply about this topic.
Well, happy to have been able to join in and enjoyed it myself. So,
thank you, Grady.
Thank you.